So what is balance sheet? In the last video, we understood the basics of profit and loss statement. Now, let's take a look on balance sheet. So a balance sheet showcases liabilities and assets of a particular company on a particular date. Balance sheet consists of two sides, liabilities and asset. Now let us understand what is liability. So liability means what a company owes to someone, whereas asset means what a company has to own for someone or receive from someone. Both the liabilities and assets can be further divided into further two categories. So liabilities into non-current liability and current liability, whereas assets into non-current asset and current asset. Now let us talk about current liabilities. Non-current liability which are due only after 12 months, whereas current liability are the liabilities which are due within 12 months. Similarly, non-current assets are those assets which can be realized only after 12 months and they serve the long-term needs of the business, whereas current assets, they can be discarded, sold or consumed within the 12 months. Now that we are familiar with the structure of balance sheet, let's take a look at the major line items in balance sheet. So in liability side, you have shareholders equity, under which you have equity capital and reserves and surplus. Then moving on to the non-current liabilities, where you have borrowings, lease liability and other non-current liabilities. And then finally you have current liabilities, under which you have borrowings, lease liability, payables, customer advances and other liabilities. So this sums up to the total liabilities, which is total liabilities plus shareholders equity. And on the right hand side you have assets, which consist of non-current asset, under which you have fixed asset, goodwill, investments, other non-current assets. And then you have current assets, under which you have cash, investments, receivables, inventory and other current asset. So that is the total assets. So as per the basic principle, total assets is equal to total liabilities, which consists of current as well as non-current, plus you have the shareholders equity. Now let's take a look at the key balance sheet items from a stock analysis perspective. So any business requires capital to grow and sustain its operation. So you have capital divided into two things. First is equity and second is debt. So now let us look at them one by one. So first is shareholders equity. So shareholders equity consists of equity share capital and reserve and surplus. So we'll talk about equity share capital. Equity capital is the capital that is contributed by the shareholders. Now let us take an example of it. Suppose a company is being set up today with a share capital of rupees 1000 crores. So let's assume the issue price is rupees 100 and number of shares is 10 crores. Thus, in this example, you can see the company raises rupees 1000 crores via equity route by issuing 10 crore shares at rupees 100 per share. Reserve and surplus. So over the time, the company reports profit which gets accumulated in its reserve and surplus post payment of dividend. Subsequent equity capital raised at premium to its face value also flows in the reserve and surplus. Healthy and steadily reserves implying good profitability and internal accruals for a company. Such company requires lesser amount of external funding through debt and additional equity for further expansion. Borrowings. So borrowings is the money which the company has borrowed through various sources such as loan from banks and through bonds, debentures and fixed deposits. Non-current borrowings. So non-current borrowings is the money which is raised for long-term durations such as setting up of a plant. Next is current borrowings, where the money is raised for short-term durations as for working capital needs, which is day-to-day work operations of the business. Payables. So the company purchases raw materials on credit with agreement to pay later. Money owed to the suppliers is termed as payables. Payables increases when the company purchases on credit and it decreases when the company pays back the same through the actual cash payment. Looking at the other key line items on the liability sides, so you have lease liability, which is the present value of all the future lease payments. Then you have customer advances. It means that the money which is received in advance for products or services which will be delivered later. and you have other liabilities such as deferred tax liabilities and provisions. So that was all about liabilities. Now let us move to the asset side of the balance sheet. Fixed asset. So that includes land, building, plant and machinery, plus other leased assets such as office premises, intangible assets such as patents, copyrights, software, etc. So these assets are depreciated each year based on the total useful life of the asset. So what you see in a balance sheet is the net block of the fixed asset, that is the value of the fixed asset after depreciation. So cash is the most liquid asset. Cash in hand is the cash on the company's book. Companies also keep excess cash balance in liquid investment such as current accounts and short-term FDs with banks and investment in liquid mutual funds. Cash and cash equivalent is majorly impacted by the following two actions. So first, you have fundraising, the money that the company raises by issuing shares through IPO, FPO, rights issue, QIP, preferential issue, warrants, ESOP and conversion of warrants or by borrowings adds to the cash balance. And second, you have fund utilization, where the money is used for normal company operations or acquisitions of companies, capex, debt, repayment, dividends, which reduces the cash balance. Receivables. The sales done on credit is termed as receivables. A company sells its good to a dealer or a customer and receives the payment later. Receivables increase when the sales are made on credit, and it decreases when the payments are made by the customer or dealer to the company. Inventory. Inventory includes all the raw material in stock, goods under various manufacturing processes and finished goods ready to be sold. Inventory increases when the company purchases the raw materials or if the finished good inventory is not getting sold, and it decreases when the finished goods are sold. Working capital. So working capital is the money deployed by the business to run its normal day-to-day operations. So working capital is equal to receivables plus inventory minus payable. Goodwill is created when one company acquires another company and is an intangible asset. It reflects the premium that the buyer pays in addition to the net value of his other asset. Investments. So investments is the money deployed by the company by acquiring minority stakes in other companies and joint venture, as well as investments in other listed and unlisted securities and mutual funds. Other non-current and current asset. These include deferred tax asset, loan to other group companies, prepaid expenses such as advance money paid to the vendors, advance rent and bill payments. So that is all about the asset side. Apart from these line items on the balance sheet, there are few off-balance sheet items such as contingent liabilities. Contingent liability is a liability that occurs depending on an outcome of the uncertain future event, such as legal dispute. Now, let us discuss what a healthy balance sheet represents. So few of them are: first, you have robust net worth, which is the sum of shareholders' equity and reserve and surplus. Second, debt-free or relatively lesser debt as compared to the net worth. Then you have a healthy mix of fixed asset in case of asset-heavy manufacturing businesses, or lower fixed asset in case of asset-light business like IT, QSR, FMCG, etc. Then where you have core working capital days, that is debtors plus inventory minus payables, which is having less than 60 days or negative. Then you have healthy cash and cash equivalents or healthy investment in short term, which is less than 12 months, or long term, which is more than 12 months in quoted or unquoted investments. And then you have negligible contingent liabilities. Let us look at some of the red flags in a balance sheet. So the first one is where you have a higher proportionate of goodwill as compared to the overall balance sheet size. Second, you have disproportionate rise in receivables and inventory over a period of time. Third one is where you have higher levels of debt as compared to the net worth. And the fourth one where you have disproportionate increase in contingent liabilities. Some key ratios which we can compute from the balance sheet are debt to equity, fixed asset turnover, working capital turnover, and working capital days. So these all will be covered in the ratios video. So this was an overview on the balance sheet. Stay tuned for the next video on cash flow statement. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.